Hello and welcome back to another video. This is going to be the understanding gamma video that I think I've been promising you since forever, finally getting around to filming it. In this video, we're going to break down exactly what gamma is, how to read the gamma heat maps that I share over in the Discord and the GAX charts, and most importantly, how this information can actually be useful in your trading, whether that be day trading or swing trading. I'm going to give you some real examples using SPX, and we're going to look at some individual stocks as well, and then hopefully by the end you'll have a much better understanding of how gamma is actively involved in price action. Firstly, let's go right back to basics and start with what gamma actually is. Now, to understand gamma, we first have to understand delta. Now, delta measures how much an option's price changes when the underlying moves $1. So it's basically the option's sensitivity to price movement. A 0.5 delta option means it moves 50 cents for every dollar that the underlying moves, and gamma just measures how fast that delta changes. And why does that matter? Well, market makers and dealers are in the business of selling options to collect premium. They don't want to take directional risk. So when they sell an option, they hedge, meaning they offset their risk by trading the underlying stock or index. If you think of it this way, if a dealer sells you a call option, they are now short that call. If the market rallies, they lose money on that short call position. To protect themselves, they buy shares of the underlying. And that's just what hedging is. It's neutralizing directional exposure. Now, this is about to get complicated, but bear with me here. This is where gamma comes in. So let's say they've sold 1,000 call options at the 6,200 strike on SPX. When SPX is at 6,000, those calls might only have a delta of like 0.1 or 0.2. Let's say 0.2 just for argument's sake. This means the dealer needs to hold 20 shares worth of SPX via futures or ETFs per contract to stay neutral. But as the price rises, as the underlying price rises, SPX rises towards 6,200, the delta of those options increases. Maybe it goes from like 0.2 to 0.3 and then to 0.5. Now the dealer needs to hold 50 shares instead of 20. So they must buy an additional 30 shares to maintain their hedge. This is just forced buying and selling to maintain a neutral position, and that's what we're referring to when we're referring to dealer hedging flows. Okay, so what does this all mean? Let's head on over to OptionsDepth to have a look at this. Now, you can also use open over to Periscope in a second to also look in there. But let's have a look at OptionsDepth first. This looks a lot scarier than it is, I promise. The layout is actually pretty straightforward. So this is our gamma heat map from, I think this is from the 29th of May. And here we can see we have our strikes along the vertical and we have our time along the horizontal axis down here at the bottom, and the colors on this chart just represent gamma exposure. Very, very simple. So where you have blue areas, we don't have any real deep blue areas. I will show you an example with a real deep blue area in a minute, but where we have blue areas, they represent positive gamma, and you can also see this. You see the value number changing as you move through here. So you see at the moment, all this is like value 150, okay? So it's all positive. If we go down here to this red area, we can see the values become negative, minus 389 there. So blue is a positive gamma area, and these tend to be stabilizing zones where price can either get stuck or price will reject from if it's a really strong blue area. Again, I'll have a look at that in a second. The red or the orange areas show negative gamma zones, and these are areas where price will often speed through these areas. Acceleration will pick up through these areas. So what's the difference between positive and negative gamma? Well, in positive gamma, as price rises, dealers will sell to maintain the hedge, and as price falls, they will buy. So this dampens volatility, can also create big gamma walls where we will struggle to get over those strikes. I'll show you an example of that in a moment. In a negative gamma environment, though, dealers are usually net short options, and that creates negative gamma. Now, when price rises, dealers must buy, and when it falls, they must sell. So that amplifies moves in both directions. And that's why I say if we get into a negative gamma, a red area on this map, we are more likely to power through that red area, whereas blue areas tend to stabilize price a little bit more. Now, gamma peaks, which are areas of particularly high gamma, can also create support and resistance for us as well. So if we look on here, for example, the green line here is the gamma peak. So that's where we have like the most gamma. You can see the value changing here. It changes from 145 to 164 to 175, and then we hit the peak here at 177. And look where we bounced from, pretty much bang on that gamma peak, and it happened again more or less here, and then price just kind of stabilizes along that gamma peak throughout most of the rest of the session. But what would have happened then had we started to move up into this area, for example, we flip from positive to negative gamma, that's what this black line represents, we more than likely, these aren't particularly big values if I'm honest, but just for argument's sake, the purpose of this video, we more than likely would have moved through this area relatively quickly or with relative ease, especially as the negative gamma values become bigger up to this line sort of around 5940. So if we have a look at another example here, this chart is slightly more interesting, a little bit more going on here. You can see we have a lot of very positive gamma up around this 6,300 strike, and that was present throughout the entire session. What this tells us is there was a very good chance we weren't going to move through this area of extreme positive gamma. Look at those values, 2,817, 2,676, huge values. We were unlikely to move through those. They were too great of a value. It's basically creating a lot of selling pressure in this area. Remember, as price rises, dealers sell to maintain their hedge in these positive gamma environments. Now below us, we also had a negative gamma environment, very, very red area here towards the end of the day with really strong negative values. Now, again, we didn't see this, but what could have happened here is had we fallen down into this sort of price range, really past where we have this flip between positive and negative, if we'd have fallen down into here, especially down to this kind of 6272 level, we would have most likely very quickly fallen down to around this 6267.5 level, or even slightly lower, where we would then flip into positive gamma and we'd likely find some support around here. Now, one other thing we do need to talk about here is delta. When the delta of an option is very, very low, it doesn't generally have an impact in this way via gamma until the delta is high. And what we mean by that is, let's take this big gamma level around 6,300 here. At the start of the day, the delta of this 6,300 strike was pretty low, which meant the gamma was still present, but it really didn't mean anything much because the delta was low. We were so far away from the strike still that this we could see, we knew it was a wall, but it didn't mean anything until we got closer to it. And we need to ensure that delta has risen on that strike for it to become a relevant key gamma level. Basically what I'm saying here is take note of key levels that are extremely positive or extremely negative gamma, even if they are further away from our current price, but just be mindful that those levels might not mean a lot until we get closer to the strike. Don't trade off of those levels, for example, until we get closer to the strike and the delta of those strikes become more relevant. Here is another example this one's from the 2nd of July. Here we were extremely stagnant almost all day, just moving sideways. And you can see, especially as the day goes on, this area of extreme positive gamma up here. This basically acts as a resistance. We really struggled to push across it. We did start to move into it towards close, but we didn't close above it. We were very much range bound around the bottom of this area of very positive gamma. Now, down here, we had an area of very negative gamma. What could have happened is, had we started to drift down towards these strikes, if we had fallen into this negative gamma zone, especially towards the end of the day where these values become extremely extreme, we most likely would have seen price move very quickly. In this case, let's say from around here at 6157.5 down through to around 6145 very, very quickly through this area of negative gamma. So gamma is basically showing us a few things. It's showing us where we might find support, where we might find resistance or stickiness, and also where we might find levels that we move through very, very quickly. So all of this I've explained a little bit more about how to read those gamma heat maps from OptionsDepth, and I do share these into the Discord group as well quite regularly, so hopefully that just gives you a little bit more background and information about that side of things. But on the other side of that, another type of gamma chart that we look at are the gamma exposure, or GEX, which is the same thing, bar charts. Normally we share these for individual stocks because we don't have the heat map ones, or I don't have access to the heat map ones for individual stocks. And also normally when we're looking at individual stocks, we're looking more at swing trades. So we're looking at, instead of 0 DTE positions, we tend to be looking a little bit further out. Now I get these from optioncharts.io, but you can also get these from tools like Unusual Whales. And these are showing us something ever so slightly different to those heat maps that we just looked at in OptionsDepth. These GX charts are showing us the total gamma exposure at trust. So it's not quite as detailed as the heat map, but it's extremely useful for a couple of reasons. Let's look at this by just having a look at an example. This is the GX chart for Google. Now, each bar on this chart represents how much gamma is sitting at each strike. So the height basically tells you the magnitude of gamma at each strike. And you can look at this as net, or you can look at it separately as both call and put exposure on the second chart as well. So looking at this one from Google specifically, I've got this set to the next month-ish worth of expiries, but you might want to set this further out if you're trading options further out than this. What I'm looking for here is, are there any areas of key support or key resistance? In this case, this large gamma bar here tells me there's likely resistance around this area. Now, I want to be very clear that these numbers are obviously going to be in multiples of either, it will depend on the stock, right? But they're most likely going to be in multiples of either 1, 2.5, 5, or multiples of 10. Now, I mention this because this here tells me big resistance at Google at around 180. But that might not translate to exactly 180 in real time. I'm not going to expect price to hit 180 and then just reject. Most likely, we're going to start to see some stall and some rejection slightly above or slightly below. It's just around that strike. And let's see what happened. So this is the 15-minute chart for Google from yesterday. And if you have a look at here, you can see we had rejections from around 181 and then here at around 179.5. So 50 cents away, actually, yeah, slightly less than 50 cents away from that 180 strike. And then also once we got above that strike, it just came plummeting straight back down again, and we may see a further rejection on this candle here. Obviously it's closed now, so we don't know. If we put extended trading hours on, actually we can just see that it is struggling at this level, which is not really moving much at all up or down from around this level here. Obviously it's very, very close to our 180 key gamma level on this chart. Now, so why is this important? What does this tell us? It's telling us a couple of things. Firstly, as price approaches 180, dealers are short these calls and need to buy shares to hedge, and this creates buying pressure initially. And that's why I say we don't expect it to like hit 180 exactly and then boom, big sell off. The hedging is going to happen around 180, but once we get to 180-ish, dealers are going to be fully hedged and the buying pressure disappears. And that's when price often stalls or reverses. Now, I am oversimplifying this slightly for the purpose of this video. That is a roundabout explanation of what's going on. So again, when we go back to Google's chart, it kept trying to break 180, tried to break 180 a few times, but never really got there. And not once on the 15-minute did we see a candle close above it in recent days. And that's not random resistance. That's just how gamma mechanics work. So why am I telling you this? Well, you need to check these charts before you enter positions, especially if you're entering swing positions or fairly short-term positions. You want to look over the next few days or the next few expiries. Do we want to enter calls, say for 185, when price is struggling to break 180 because we know there's a big key gamma wall there? Most likely not. Or we can use it to our advantage in the sense of, okay, if we know we're unlikely to break 180, let's set an alert slightly below it, 179.5 or something. Let's wait to see if we can get any type of significant rejection. Let's see where the next support is. There's no significant obvious support on here. You could argue 177.5 or even 175 here, but really neither of these are particularly significant. And let's try and re-enter at the support. We did this recently with ANET. I'm going to show you this trade from ANET, but because it was a past trade, it was from maybe about 10 days or so ago. And I don't have the screenshots from the gamma exposure at the time. I can't show you what it looked like. But when I checked the gamma exposure at the time, it looked very different to this. And I could see we had some clear support at 85 because we had a big line like this one, but at the 85 level. And I could see we had a lot of calls targeting, I think it was around 95 at the time. So why waited? I set an alert. I waited for price to drop down here. I had alerts set all the way down, I think from about 87 through 85. I entered around here, around the bottom of this 4-hour candle, when price was around 86.69. Yeah, because I was confident that the 85 support would hold, so I was prepared to hold through a little bit of drawdown if it was necessary to do so. But like I said before, just because there's a big wall at 85 or a big support at 85, it doesn't necessarily mean price will hit that exactly. So I wanted to get in here because I felt comfortable doing so. I was confident in my decision. But had I started to see candle closures, especially on slightly higher time frames, say on the 1 hour and the 4 hour, had I started to see candle closures below that 85 support, I probably, but I was confident to enter here and I wanted to target, I think we bought 90 calls, but actually we rode this up quite a bit. This was like a 400% trade in really only a few days. I held through a little bit of drawdown here, but again, no candle closed at all below that 85 support, and actually we just bounced straight up from the 85 support. And had you held on to this would have been a really good trade. I think it maybe would have even hit like 500%. But the reason why I entered this trade again was because when I checked on the gamma exposure, I could see a lot of support at the 85 strike. Here, now, I can see a lot of support at the 100 strike. So if ANET were to pull back, and market conditions generally were still very good, obviously if the entire market just starts to sell off over the next couple of weeks, ANET pulls back to 100, the entire market is still selling off. Not necessarily a good idea to just go and enter calls there, but if everything's still kind of positive and momentum is still good, If we see some type of pullback to 100, I want to be watching to see if that support holds. If it holds around 100, then I can probably enter calls to the next key strike, which in this case would be 105. Now, there are a lot of other things at play here, and I want to make that really clear. You can't just trade off of gamma levels. It's not practical. You still need your charts. You still need to be able to understand market maker positioning, and things like charm as well are really important. I'm going to make a separate video on that. But having this understanding, starting with gamma, which in my opinion is the easiest of all of these different things that you need to be aware of to understand, is a great starting point. So let's just take a second before we end the video to consolidate some of the most important points here. Firstly, gamma without delta doesn't really mean a lot. It's potential energy, but it's not kinetic. In positive gamma, which is blue on our options depth chart, more likely to see chop and range bound movement, and it can also act as a resistance to move higher, especially when it's extremely strong like it is here. On the flip side of that, in negative gamma, we can generally expect price to move quite quickly through these negative gamma levels, especially where we are in heavy negative gamma. So as we mentioned, had we been down here towards the end of the trading day on the 2nd of July, we most likely would have seen price move very, very quickly through these strikes down here. Your GEX charts for individual stocks, just like this one that we were looking at with ANET and the one with Google, will be able to see where we have key areas of support on the downside and key areas of resistance on the upside. And remember, this isn't some magic wizardry. You still need other analysis to help you understand, but understanding gamma explains a lot of price action that might otherwise seem random, or you might have got caught out a few times before, entering calls because a stock looks like it's going up, okay, we're going to jump on that bandwagon, but actually it was fast approaching a key gamma resistance, and we don't want to enter calls right when we suspect we're going to see some sort of stall or even rejection. If you want to learn more about this or follow along with daily gamma charts and updates I post, I will leave a link to that in the description. If you have any questions about anything that I've been through here, do drop them in the comments and I will try to help as best I can. Thank you for watching, and I'll see you in the next video where we're going to talk more about charm.